Hello everyone, this is Fair Value Finder. Today we're taking a look at the NVIDIA Corporation, ticker NVDA. They had their earnings yesterday and are off to the races, touching almost 26% up on the day. So incredible stuff, almost up $80 a share. We're going to start with the financials, then we'll look at the charts, then we'll look at those earnings. So we can see that 2022 was a terrible year for them. So there's not a whole lot to talk about there. It was down from 2021, unless 2021 was just exceptional, but looks like they may be back on track with those 2021 numbers. So it'd just be a down year 2022 for chip stocks. That's not unheard of. They all saw a pretty rough year. As for the long-term trends, the compound annual growth rate from 2019 to 2022, revenue up 35%. The expenses are outpacing the revenue, not something that we really like to see. I mean, they're relatively low, but still, we'd like to see more growth in that top line. Gross profit is growing very quickly, 31%. Net income 16%. Their expenses, like total expenses, up 38.4%. Their expenses as a portion of revenue have been creeping up, approximately 2.4% year over year. There was a big jump this last year. Maybe they can get it back to that 60%. EBIT has been growing, up 13.71. Gross profit and net profit have been declining, but their earnings per share have been increasing with some pretty good growth. Right now, they're trading for a PE of about 115. Traditionally, they trade around 60. So that put the fair value as of the end of this last year around $200 a share. And then going forward, analysts are expecting $4.59 this year, which will put them at $273. And the following year, $6.16, which put them at $366. So this company is a very big growth stock, trading out at valuations way out in the future. Probably about 4 years out is the share price that I'd say it's trading at right now. And the market does not seem to care about anything aside from those earnings on this stock. Assets, they do have a significant amount of assets and a positive book value. They grow those assets, but they're also growing the liabilities rather quickly. Very minor portion of their value comes from their book value. Free cash flow, they're not a very strong free cash flow company. They do not have a whole lot of cash left at the end of the day, but in such a competitive industry, that's probably a good thing. They're investing in research and development, building new centers, whatever they need to get the edge. The share count has been declining. They've been buying back about 1.5% every single year. Shareholders' equity is all over the place. 2022 was a rough year, so they'll probably get back above 27 million. And then their dividend, they are not a dividend stock, really. They pay out 0.42% yield. They've held it at $1.16 a year for about as long as I could see. So that's not something that they look like they're interested in. Again, in a competitive industry with such a growth stock, they should be focused on growth, not a dividend. ROE, I'm kind of surprised about how low this ROE is. It's not even at the 20 that we really like to see something above. 2021 it was, but that's something that I found interesting. It's fluctuated around that 20 mark, but still doesn't really hit the minimum that we're looking for. This, of course, is not a value stock, but the Lynch formula gives it a 0.09, which is significantly overvalued. Very, very significantly overvalued, almost not even worth touching. But now we can go look at the chart, and I have something interesting that I noticed on that. The chart for the stock, I did not draw lines on it because it's kind of been all over the place. I mean, it had reached way up into the 300s late 2021, and it's reaching there again today. But the interesting thing is kind of the support and the resistance are those fair values that we looked at for the earnings. I had said that based off last year's number, fair value would be about $200. So they hit that in April of last year. They hit that value, and they were under it for a majority of the year. So if you knew that this was strictly an earnings growth stock, you could have said, okay, if I'd say a fair value for that metric is 200, a good entry point for this stock would have been around 175, giving you a pretty good margin of safety. And this stock dropped all the way down to 112 and has been on the rebound ever since in October of last year. With these forward earnings, if they come in as expected this year, they get up to the 270, mid 270 range, which they have seen before. They gapped way up above the last time that they broke 300. And then when they came back down, they caught some resistance there. And they recently caught some resistance there as well before these earnings came out. It looks like anticipation for these earnings kind of helped push them above that resistance, and they are off now. There you go. I didn't even have the candle for today in there yet. You can just see how crazy it is today. It'll most likely come crashing back down because even 3 years out, we're looking at 366. Unless they are completely going to crush analysts' expectations, this stock will probably come back down somewhere between the 275 and 360 level and stay there. But now let's take a look at these earnings and see if they give any forward guidance that could help us. I just want to give a quick one-over of this. I don't want to spend too much time on it. Quarterly revenue up 19%. Data center revenue record. And here we have the numbers. We see that revenue is down. Cost of that revenue is down as well, giving them a gross profit quite a bit lower than they came in last year. Net income did end up higher, so they had less expenses somewhere along the line. They had interest income profit significantly greater than last year. That really helps them. And that seems to be where the majority of this came from. Yes, that's where it all came from, because after that, their income before tax ended up higher than last year. Not really something that I'd be looking at to warrant the stock to be up 25%. So they must have said something in their earnings call. We see assets are up, liabilities are up as well. They're still keeping with their debt is less than half of their assets, which is something really nice to see. Cash flow, net income was higher. They ended up with quite a bit more cash provided by operating activities. Investing activities, they invested a lot. Last year they had made a lot. Financing activities, significantly more last year than there was this year. So they come to a cash equivalents at the end of the period of $5,000, and cash at the end of the day was lower than last year, basically in line. We see their gross profit around 65%. That is what they came in at 2021, so that is better than they had done last year, something that we do like to see. Their free cash flow is up. It's nice because that was one of their lower metrics. Well, that's what I'm seeing in their earnings. There's not really the forward guidance that I was hoping to see. Definitely not anything that I would say warrants a huge run on the stock like this. I know that they are expecting AI to be their big driving factor, because they're one of the main players in AI that they claim. We saw in AMD, they said almost the exact same thing. So that's a lot of BS. If this is what you're buying it for, you're probably being misled. I do find the correlation between the earnings per share values of this stock and analyst expectations, the chart, to be very interesting. So this might be one that I start to look at, and if it goes back down, not that I'd expect it to anytime soon, it'd have to have another rough year, but if it were to go back down between 200 or below $250, 200 to 250 would probably be my buy zone on this. Do I see a reason to sell the stock? Not if they can come in as analysts are expecting. If they underperform, then they will be punished. But if they overperform, you're going to see days like this. So I'd have to give it a hold. I don't think at the prices today, I don't think that there's a whole lot more room for it to go. It's going to come back down. Right now, it's just a momentum trade, which, as we've seen in the past, it's got huge ups and downs. It's definitely a momentum stock with an emphasis on the earnings. So once it starts coming down, it could be a nice little trade to make some profit. Now that's what I see on the stock. I'd be looking for that 250 below range before I get into it. So I want to thank you guys for watching. Please like, comment, subscribe. Let me know what you want to see, and I'll catch you next time.